Okay, we are going to get started. First of all, I'd like to thank everybody for joining today for a MetalMiner webinar, which we're calling the MetalMiner Way. You'll get the kind of inside joke humor at the very end if you have not realized it already. It's based on a white paper that we published a few months ago. And the primary focus of this is to kind of leverage, I would say, the dual expertise that Lisa and I bring. I like to describe myself, despite my role at MetalMiner, as the village idiot when it comes to specific metals. I'm definitely learning quite a bit there for sure, but I am an expert in source-to-pay technology. And the purpose of this webinar and the white paper, which is going to be linked in the chat stream if it's not already, is to showcase how deep price intelligence can fit across the source-to-pay spectrum. And we'll share some chevrons, talk about how it fits into each area. Now, while metals is the focus today, if you have other commodities which you purchase semi-finished, finished, or even raw materials, the concepts we apply here for metals are also applicable there. So I hope there are the others from this webinar too who don't just come from metals. So if you have existing source-to-pay systems, hopefully you can leverage some of what you learn here, not just for metals, but beyond. So I will quickly introduce MetalMiner. We're not going to do an advertorial here, just about 30 seconds on the challenges our clients face and kind of who we are. Essentially, we are a very deep category solution for metals procurement, typically large OEM buyers, but even SME and middle market companies as well. Our clients typically face four challenges: price volatility in the markets, whether companies are sourcing project to project or steady state and steady POs, lack of forecast, really putting a thumb in the air as to where the markets will go and determining a buy strategy based on that, savings and margin erosion. This is kind of a piece out of history. I was at free markets some 25 years ago, and savings and margin erosion in metals was the same then as it is now. And then in contracting decisions, should you buy on the spot market or long term? You don't want to get stuck holding high-priced inventory. So these are the common challenges our customers face. And our solution is a product we call MetalMiner Insights. It combines live price updates with accurate forecasts, sourcing strategy recommendations, and cost modeling. And for all these statisticians in the room or wannabe statisticians like me, correlation capability as well to understand how markets move together to determine an optimal category strategy for metals. For some companies, this is focused on risk reduction. For many others, it's focused on EBITDA and margin improvement. So hashtag advertorial over. Let's get on with the fun stuff. This is why you are here. The MetalMiner Way. What is it? And again, while this is focused on metals, it's applicable to other commodity and category inputs as well. So if you are a larger organization or a middle market company and you purchase the source-to-pay system, you're probably thinking commodity data and detail may flow into a spend analytics tool, but in general, it's pretty separate. We're not going to leverage it across the spectrum, from spend analysis to category strategy to e-sourcing to contract management to procure to pay in the form of price compliance. But in fact, price intelligence should be embedded across the entire spectrum on the commodity side. And kind of the spoiler alert here is that you got to go beyond the headline number. The headline number, the exchange traded price, the price the supplier quotes you, is not the detail you need to leverage savings and opportunity and risk reduction across the source to pay spectrum. So with that, I will introduce my colleague, Lisa Reisman here, who will provide a bit more detail beyond what I just shared.
Thanks, Jason. So I think what I want to do is to try to make some of these examples alive and kind of walk through. And, you know, I think I'm what I call a retired consultant. So can't follow something unless it's got all of the chevrons there. I think in the traditional source to pay, as Jason mentioned, landscape, there's been not very much published around the role of price intelligence in general. And so as we go through here, my goal is to kind of share some of the lessons learned that we've seen in the market and offer some of these, you know, more subtle hints in terms of strategies that companies can deploy. So one of the things in consulting that I used to always laugh over and use is the classic 2x2 matrix. And that 2 by 2 matrix is always, essentially, and there's a lot of them that have, with formal names that have been used in the procurement space. But in the 2 by 2 matrix, companies tend to go after the categories with the largest spend. And then ideally, you pick ones that have, are lower hanging fruit. And what we've learned is sometimes your best win or your fastest project is definitely not your largest category. And so, one of the things we look at is sometimes you think like, oh my gosh, our steel spend is so massive and our aluminum spend is such a tiny fraction compared to the steel spend. Maybe we should look at the aluminum category first because it can generate a bigger percentage savings, and or you can get the win in an easier way. So that's just kind of like turning a thought on its head. One of the things that we like to do is sort of explain, what makes us different than our competition. I would say this very first point, what makes us different is a lot of companies track an ingot price, for aluminum as an example. And that ingot price, this is the example I love to say, if you're Ford, you are not buying an ingot. You are never coming in contact with an ingot. Your suppliers don't know what an ingot is. An ingot has nothing to do with what you're buying. And yet that is the exchange traded product. So we like to focus on the material, the semi-finished material, the 5052 H32 coil. That is what you are using if you're Ford to wrap the Ford F-150. So, again, looking and going deeper beyond just the exchange traded price and really understanding all the adders and extras. So, from an aluminum perspective, I kind of gave you a background there. In steel, the lessons learned are a little bit different. There's been intense focus on the core price using indexes, et cetera. And there's been almost, I'd say we've seen companies ignore the adders and the extras, the grade adders, the, with engage extras, et cetera. And typically we've found that mills and service centers are more amenable to negotiation for those adders and extras. But if you didn't know that, maybe you're just focusing again on that larger part of the spend, the base price, but knowing the price compression opportunities in the small thing. For stainless steel, it looks a little bit different, right? Buyers focus on basically the nickel surcharge, or the surcharge if they're buying 300 series grades and alloys, because there's been historically no visibility into the base prices. So that's one of the things that MetalMiner does, is to provide sort of a total price analysis where we're also providing insight into the base prices, the adders and extras that go into stainless steel, and then also that surcharge, which is the piece that can be, mitigated from a risk management standpoint. So I think part of how I think about this is that, achieving optimal price intelligence is sometimes kind of myth busting some of our go-to strategies that maybe we've used previously, and trying to look at some of the alternatives. Jason, maybe we can move on to the next slide.
Thanks, Lisa. So I'm sure there are folks in the room, I will raise my hand as well, who have been involved in spend analytics, whether it was using, Access back in the day through to the dozens of solutions available at the present state. And spend analytics can be a fantastic way to not only identify opportunities, but also to monitor implemented savings. The challenge with spend analysis, though, and I'm guilty as charged here, being a former sourcing consultant back in the day, is that it leads you to focus typically on Pareto order opportunities. So you focus on your largest categories. And one of the challenges of that is when it comes to metal spend, often the riches are in the niches. So the deeper you go, even within a large category, potentially, the greater the opportunity. But again, the headline price, which you likely have if you have a price at all on the commodity level in your spend analysis tool, is not going to go deep enough. We're finding at MetalMiner, our more sophisticated clients are embedding our data along with other commodity price data from different providers into their spend analytics tool for deep cost breakdowns to understand exactly what moves the solution area. Traditional spend analysis as well, again, focuses on top line numbers, but really the opportunity is to go deeper. And as Lisa mentioned previously, form, grade, and regional pricing. We also advise, in terms of a new way to look at spend analysis, avoid making assumptions and advocate for what we call correlation analysis to develop forecast and should cost, and even for really the weird and obscure metals. A lot of companies do buy weird and obscure, and it's not just the specific metal which you don't believe anyone else is buying except perhaps in your industry, but it could even be a specific form or grade. And there might be other opportunities as well to map that again to broader insight into where markets are going and to derive the right strategy. Lisa, I'll leave it to you to talk about the rest here.
Yeah, you covered most of this, and I think I covered the Pareto piece in the previous slide. So I'm just going to focus on the third bullet point around correlation analysis. And I want to give an example. In fact, I was speaking with a company yesterday where this exact example came up. The company purchases a lot of steel plate, carbon steel plate. And there is a misnomer, or rather an assumption in the marketplace that heavy melt scrap, HMS number 1, is best correlated with steel plate. And let me back up a second by saying that steel plate, obviously, it has its own price dynamics that are separate from the other forms of flat rolled steel, like hot rolled coil, cold rolled, and hot dipped galvanized. And so, we actually pulled up a tool and said, and the problem was that person had no way of hedging their plate spend. I said, well, you could use the shredded price, or rather, sorry, excuse me, the busheling, the number 1 busheling. And so what I did was I pulled up a correlation tool and showed that number 1 busheling actually has a tighter correlation with carbon plate than HMS, which is what the industry, most people in the industry, if I was to like post that on a LinkedIn as a poll, we would have a lot of people saying that that's what the actual correlation is, only to discover that it's actually incorrect, that it's really the correlation is not what you thought it was. I think the other thing that's really interesting is that things go in and out of correlation over time. And so I'll give an example. We do a lot of work in electrical steel. And for a long time, we were looking to try to figure out what correlates with electrical steel. And for a long time, lithium correlated with electrical steel, which makes sense when you consider that, lithium is sort of, used in a lot of renewable energy applications, and grain-oriented electrical steel, of course, is used to make power equipment, power transformers that are kind of transferring that energy. So it's logical to think that there would be a correlation until there's not. And eventually that correlation broke down, meaning it wasn't something that can kind of help guide where prices might go for grain-oriented electrical steel. So things like a Bloomberg terminal, they have correlation capability built in. We have correlation capability built into everything that we do. And this is really helpful, again, also for the weird and obscure, but also just to understand, are there risk mitigation strategies I can take advantage of that I didn't realize I could? And the answer is yes. And that's kind of that steel plate example. So Jason, I'll turn it back over to you.
Perfect. So now we'll hop into category strategy. So when we think about our philosophy here, the MetalMiner way, we are really talking about a comprehensive category portfolio strategy to mitigate price risk. There is no one size fits all, even within a single category. Even if your organization has a non-hedging policy, at least with formal contracts on an exchange, there are ways you can hedge price risk. And you can look at that from setting long-term agreements with suppliers to floating the market. You can also look at obviously splitting out the commodity price fluctuations on contracting as well. The key point here, though, is one size doesn't fit all, and one size doesn't fit all from month to month either, based on where the market is and where the market is headed. So here, we are really focused on developing a comprehensive portfolio strategy approach, which again stands in contrast to how many companies look at their direct materials spend. They look at it kind of category by category as one size fits all. When we look at the MetalMiner way, we are focused, again, not only on a high level around that portfolio, but also working with and often consolidating spend so we can focus with suppliers and joint cost takeout and innovation as well, optimizing the supply base for better performance. One example that Lisa, Don, and others on the team like to cite as well is many companies do not necessarily know they have a large enough spend to go mill direct, but in many cases they might if they aggregate and look at it collectively. We also like to emphasize focusing on long-term savings opportunities over short-term gains. Short-term wins will certainly please certain individuals in a company, but over time, a short-term win can erode, and it can actually lead to reduced savings opportunities or even losing to the market and your competitors. So Lisa, I'll leave it to you to share some more insights here.
Yeah, so I think an example that I wanted to share is kind of post-COVID and how thinking through category strategies. I feel like we have a little PTSD after a rough couple of COVID years. And again, I'll kind of speak to some examples, companies we've spoken to. Um, there were a lot of companies that got burned post-COVID in the cost run-up of a lot of commodities. There's a tendency to panic buy. It is innate and it's part of our human nature to do that and to, hoard, etc. Obviously, there's a lot of complications to that, but I think what it has done from a PTSD standpoint has shifted some companies' entire focus to be all about risk mitigation. And, I think, there's sort of this continuum of how do I get cost savings and make sure that I'm buying effectively and competitively so that I don't take myself competitively out of the process if I'm bidding on jobs, as an example, and also mitigating risk. And so I think a lot of things like in our political world today, there's a lot of like lopsidedness of what's happening. And I think companies are struggling to find that fulcrum in the middle between those two tasks. And, just to tell you how kind of alive and aware we are of that, just in May, when copper prices started skyrocketing, we received, kind of a wave of phone calls and people were panicking. And we kept saying, stick to the strategy, stick to what we're saying in our, in our buying guidance. We really view this as a speculative bubble. Do not buy long, buy what you need. Buy what you need for the orders you have in your book that you need to cover for, but don't buy long yet. We're not giving you that long-term signal. And so I think a lot of that is because a lot of commodity managers and category managers and strategies don't have a lot of experience in like, what do I do with all of this volatility? I mean, we have seen so much volatility that I think it's kind of created a little scar tissue for the organization to kind of get back in the middle. And I guess what I want to say is, here we are in 2024. Many of you are starting to be planning your strategies for 2025, how you want to negotiate. I'm going to encourage you to think a little bit more in the middle, to try to like get yourself a little bit more in the middle, balancing, cost savings with risk mitigation, and don't make sure that you're not too far on one side or the other, really.
And there's also some broader elements here too, in terms of category strategy, which we haven't really touched on very much so far, and we can go into on future webinars. But if you think about the portfolio, it's also possible to think about multi-tier aggregated contracts if you're a large OEM. That's often not done, but if you look at yourself as a buyer for your supply chain, there are ways to leverage in rebate structures and others to encourage suppliers to participate in an aggregated buy. You can look at offtake and tolling agreements as well. So there's really a lot of opportunities beyond just looking at this as kind of a single category or even single area of metal spend.
Exactly.
So sourcing negotiation. I come from the world many, many years ago of reverse auctions. There's a place for auctions, but there is a kind of a, I would say, a much broader element to consider when it comes to commodity procurement. And here, the MetalMiner way emphasizes really preparing detailed should cost models before negotiations. You should understand more than your suppliers around where the price is and where it's going and all of those cost breakdown elements. Right now, in many cases in negotiations, there's an information asymmetry. Your suppliers have more information than you. But if you do your homework up front, you can have the same level of information or even deeper insight. We also focus on setting up sourcing strategies based on market conditions versus supplier preferences. All too often, our suppliers will sell us on their terms and how they want to sell versus mapping to our buying strategy, which is based on current and future market conditions as we forecast them. It's also here, kind of as a next step, important to control the negotiation narrative and to anchor discussions on detailed cost models. That really, again, becomes the key element of the way of driving sustainable savings. We also recommend, and something we didn't do the best job of back in the days when auctions were the preferred negotiation strategy, of splitting out costs. But if we ask suppliers to split out costs and we tie that again to the anchoring of cost models, we can gain much greater insight and negotiation advantages as well. We also recommend looking at this not in a vacuum. If you use MetalMiner, if you use another commodity price intelligence provider for metals or resin or energy or whatever direct commodity input you're buying, it's fine to use an e-sourcing tool. It's even better if you're using a sourcing optimization tool or even one of these new AI-enabled automated negotiation tools. But there's no replacement for putting data in that tool. So again, technology is your friend. If you're doing negotiation with email and Excel today, there's huge opportunity to move beyond that. And there's a lot of great technology providers in the market. But what we're advocating for here is really a dual strategy of moving to that, as well as using data as an anchoring and core negotiation process within a tool set. And really, as a final step too, if you have enough power as a buyer, and a lot of companies don't believe they have the power, even if they have tens or hundreds of $1 millions of spend in a given metals category, let your actions speak. So one example I'll have Lisa talk to here in a minute refers to letting, again, your actions speak through moving spend from one supplier to another. Sometimes taking away volume can speak really a tremendous number of words and actions more than simply negotiating directly with a supplier. So Lisa, I'll leave it to you to provide some more insight there.
Okay. I think I'm going to pick a different point first. And just as we think about, I think the should cost model piece is probably the number one element in the sourcing negotiation process that I think we have seen create the most benefit for our customers. And basically what they're able to do is take sort of these detailed models and essentially use MetalMiner to benchmark what is the 304 2B stainless price with vinyl adder cut to length 48-inch wide at this gauge. That's the having that cost split up in all of those elemental buckets is what helps drive the savings. And then we've seen companies take those models, create the, I hate to say it, the non-technology, but the spreadsheet that has those elements to that, going back to the supply base and saying, help me understand your total cost. I'd like you to break it down in this fashion. And this is where the buying organization can really see, why is this guy charging so much more for a vinyl adder or this one out of line for a cut to length processing cost? It really allows you to see that, and particularly for stainless steel, which I think in the North American market has been basically a black box from a cost perspective, and companies have felt sort of like the only thing they could do is really work on the surcharge piece. Having a detailed should cost model allows you to negotiate that spend in a much more open and transparent manner. I am also a huge believer, I learned this from Sandler, to anchor the price. It is much more effective for you as the negotiator to anchor the price, to say, our models are telling us this should be the price, and let the supplier push back on that. If you don't become the one that anchors, you're giving the power back to the supplier to offer the price that they want you to be, that they would like to see you at. And you're, in your head, you might be a far cry off of that. I think the first person that anchors, wins the negotiation. So, using the should cost model to break out all of the different elements, but also use it as the way to say, this is my expectation of where I expect you to be, somewhere in this ballpark. I think I'll just talk quick on the last one. I mean, Jason, you kind of told it. I'll kind of word it in a little bit different way. So that last bullet is, the notion is loss aversion. And it is much more difficult for steel mills, for example, to deal with loss aversion than winning new business. And the way you can win in this is really only if you're one of these very large volume buyers. I'm talking, hundreds of thousands of tons of steel. But if you are that size buyer, threatening to take that volume away from existing incumbent suppliers gives you the negotiation leverage to get the mills to participate at the price points that you need them to be at, by being able to move that. Now, if you've got 15 different suppliers, even if you have a large volume, that's way too many suppliers and you've lost volume leverage right there. So basically, I'm talking about the companies that are very strategic, that have large volumes and only have 3 suppliers. What you're doing is essentially shifting your, 60-20-20 allocations through, I don't want to say in a threatening way, but to get the mills to work with you, hopefully using your should cost models. Yeah, Jason, I'll hand it back to you.
Sure, we'll keep going here to keep this within the time limit. So contracting, again, a lot of companies have invested in contract lifecycle management tools. Maybe they have contract analytics as well. But the major emphasis we're going to place here is that if you're not embedding the right data in the contracts, you're going to lose out on the savings which you've focused on from a category strategy and sourcing perspective. So this is an absolutely critical stage of the process. And here it's important to lock in great headers and extras and supply agreements to present savings erosion. We see that all the time. To recommend allocating specific percentages for spot buys based on market forecasts. So again, don't lock in necessarily your entire spend in a single contract, but depending on the market conditions, floating a certain percentage of spend may be the right strategy. Splitting out price mechanism elements in contracts for clarity and control is also important. And here, from a technical perspective, we do recommend embedding deep price data and API feeds into your CLM systems and even your ERP data to reduce human errors within those systems environments. And also as well to keep suppliers honest. I think in many cases, suppliers make honest mistakes in terms of sending out invoices, in terms of what something was negotiated before and maybe it's off. But in lots of cases, they make mistakes, and the mistakes are all too often in their favor and not in your favor. So if you have detailed cost feeds inside your contract management systems and ERP systems or source to pay systems, you can reduce the chance of savings erosion there as well. And Lisa, anything else to add here?
I would just kind of emphasize the second bullet point. It sounds so logical. I will tell you, most supply agreements fail to add in the conversion premiums or the adders and extras in the contract to hold fixed over the duration. There's a lot of leakage in a well-intentioned contracting, methodology and process, but just make sure that you are also, getting in those adders and extras locked as price fixed over the duration of the contract as well.
Perfect. And to kind of anchor the MetalMiner way, kind of the last chevron in source to pay, we'll talk about P2P and price compliance. So all too often, once a contract is in place, suppliers will let you know if a certain element increases in their favor, but not when it decreases. So it's critical, again, to kind of monitor those non-fixed price elements within a system so that when the price moves in favor of you, you pay only what you should pay based on what you negotiated. So adjusting prices as market conditions change and embedding that within your procure to pay and ERP system. In indirect procurement, we often talk about a through a match or no PO, no pay. But when it comes to direct spend and metals in particular, being able to match those line level PO details to contract terms and conditions becomes key as well to prevent erosion. Auto population of data here really is best practice. If you're manually updating in Excel, as many companies do, we know some very large buyers who have very strong Ariba, Oracle, Coupa, Evalua, SAP systems implementations, but often for indirect and not for direct. So they're still auto-populating, or not auto-populating, they're manually populating data via Excel on a quarterly basis. But the key here again is auto-population if you can do it. And we also suggest an exception management approach here. So if there's a pricing mistake, send it back to the supplier. It's on them. Don't pay it. But again, if you're not embedding the price data across the source to pay continuum, and specifically here at the transactional level, you're going to miss it. So here, again, it becomes very key to embed this deep commodity price data within your systems, not to have it on a standalone basis, and really to get off of Excel as a means of price updating as quickly as you can. Lisa?
I don't really have anything of substance to add here other than this is something that MetalMiner does have a solution for. So if this is something that has been a pain point for you, and especially in terms of not only just like identifying the errors, but just the manual data entry, we'd love to chat with you about that. So Jason, I'll turn it back over to you to wrap.
Sure. So in conclusion, and I confess to being a Star Wars fan, and I think Disney did a great job with the Mandalorian kind of spinoff. This is the MetalMiner way. I'm sorry, I know it's really corny, but if we talk about the MetalMiner way and sum it up, it really emphasizes the power of granular price intelligence to achieve savings. Again, go beyond the headline price. Shift from passive to active in terms of not only your decision making, but also in terms of price monitoring. The MetalMiner way also advocates for dissecting cost components to uncover hidden savings opportunities. So again, the cost modeling is absolutely critical. It's also important as well to kind of bring that transformational element into the procurement process through detailed price analysis, not just on the front end, but again, throughout the source to pay continuum. And then most important of all, when it comes to informed negotiation and supply management, put data at the core, whether it's, as Lisa referred to, the anchoring in negotiation or the continuous monitoring through your systems. Have that data and surface it. So with that, we'd like to thank you for joining us today. Again, the white paper, I believe, is available via a link in the chat if you're interested in double clicking on this. And we thank you for joining us for this webinar.
Thank you.